On the first trading day of June, the FTSE 100 fell 0.6% and the FTSE 250 dropped 1.2%, but the story underneath the index was more divided than those numbers suggest. Oil was the session's loudest voice. WTI crude surged more than 8% to $94 a barrel after Iran's chief negotiator declared that the Strait of Hormuz could not be reopened, citing what Tehran called blatant ceasefire violations by the U.S. naval blockade. Iran's foreign minister posted directly on X that the sea lane, through which an estimated 25
BAE Systems carries an order backlog of roughly £84 billion. Babcock stands near £10 billion. Rolls-Royce's defense arm holds £7.3 billion. These are not aspirational pipeline figures. They represent contractually committed government spending, the most reliable revenue stream in public equity markets, typically backed by multi-year sovereign budgets that do not move with consumer confidence. And yet, over the past month, BAE Systems shares have fallen 15.7%. Babcock has dropped 21.4%, and Rolls-Royce is down 11.4%. The Iran war continues, Ukraine casualties mount, China's warnings over Taiwan have not softened, the strategic case for Western rearmament has not weakened, the political consensus behind it has hardened, not frayed. The unstated premise that the market's prior positioning required was this: order visibility translates to earnings visibility, which translates to valuation support. That chain held through the defense rally of the past 2 years. What the current sell-off reveals is that at least one institutional participant group has begun to price a different premise, that order book scale and execution capacity are not the same thing. Babcock's latest update showed full-year revenue up 10% and underlying operating profit up 19%, but it also carried a larger-than-expected £140 million charge on its Type 31 frigate program. That charge did not cancel the revenue growth, but it introduced a question that the order book thesis had not needed to answer. What is the cost of delivering at this scale, and does the government contract pricing absorb it? Countersignal as a structural condition, the Hormuz blockade is a direct transmission mechanism into defense capex logic. As Iran's blockade extends the energy cost shock and the U.S.-Iran ceasefire remains unresolved, European NATO members face compounding fiscal pressure, higher energy import bills alongside accelerated rearmament pledges. The Investopedia and CNBC coverage of the Hormuz closure explicitly frames it as a scenario in which freedom of navigation through the strait was never seriously challenged until Iran basically closed the sea lane. If Gulf energy revenues are permanently redistributed, the fiscal bandwidth for open-ended defense programs in Germany and France, BAE's key export markets, becomes a live variable. The capital that moved out of BAE Systems this month did not need to resolve that question to justify the exit. It only needed to notice that the question had opened.
The unresolved question from the paradox layer is this: if delivery risk repricing is what is happening, the verification benchmark is not the size of the order book, it is the margin on the orders already being executed. BAE Systems' next earnings disclosure will carry more weight than usual because the market is no longer reading order announcements as earnings proxies. Babcock's Type 31 charge established the gap between committed revenue and realized margin. Until BAE Systems updates its program execution data, the discount against book value sits without an anchor to close it against. The historical parallel is instructive but imperfect. During the 2010-2012 period of Western defense budget austerity, FTSE 100 defense stocks fell sharply, despite existing backlog commitments, because governments deferred delivery schedules under fiscal pressure. The parallel holds only in structure. Then, the revenue was at risk because demand was being delayed. Now, demand is accelerating, but the constraint is supply chain capacity and skilled labor, not political will. Rolls-Royce's 1,026% 5-year return shows what the re-rating looks like when execution is trusted. The current sell-off is a withdrawal of that trust, not of the underlying demand. For continuation of the current discount, if Babcock or BAE Systems discloses further program charges in the next quarterly cycle, or if AUKUS or Tempest program milestones slip publicly, the execution risk frame becomes the dominant lens and the order book premium contracts further. The specific threshold worth monitoring is whether BAE Systems H1 2026 results, expected in late July or early August, show operating margin movement on its land systems and cyber divisions, which carry less sovereign protection than air and naval programs. For the discount to close, a clean BAE Systems earnings print with no further program charges, combined with visible progress on Hormuz ceasefire talks reducing the fiscal squeeze transmission, would allow institutional capital to re-engage the backlog as visibility thesis. The checkoff anchor from the opening, that £84 billion order book, remains the number the market is not disputing. What it is currently refusing to pay for is certainty that the number converts to cash at the margins that supported the prior valuation. That refusal is not yet resolved by anything in the news flow today, and the next session will not resolve it either. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.